Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark tells us about a unique week in equity trading. PI Financial Vice President Victor Adair believes there could be more life to equity markets than many suspect. John Mauldin of Mauldin Economics breaks down the impact of lower crude and natural gas prices. We talk to Ross Clark right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy, Vancouver. Merry Christmas and welcome to This Week in Money.
And best of the season to you and all the listeners.
Wow, what a bumpy ride on the equity markets this past week.
Equity markets, and just about every other market, but there were a few that were a little quieter than normal for a change. But boy, the equity market, this is December. And December has the characteristic of selling off into mid-month. It most often catches people off guard. And in this case, we had about a 4.5% decline in the broad U.S. equity markets, that being the Dow, the S&P, and the Russell 2000. And it's very normal from a late November, early December high to have that magnitude of a break, and then that sets up for the classic turn of the year rally, the Santa Claus rally, that takes you in normally to the first week of January. That's the most reliable part of the trade, but the bias usually then carries you through January. So historically, your best returns are made if you hold through the whole month of January. But the optimum period for the short term is by that first Friday in January. So U.S. markets doing the classic type of action here. The good oversold the middle of the this week, just into the FOMC 2-day meeting, and from there, once again, dovish comments, at least dovish enough that the equity markets like them. Now, the other thing you've had is that in the Canadian market, where you've got much more of a bias towards the resource side, the TSX was down about 9.5% by midweek this week, came back to close pretty well on the week, still down a good probably 3%, 4%. Off the highs at early of the month. But the heavy tax selling pressure, usually over by the 17th, seems to have run its course right now.
What's happening with precious metals?
Metals, we're saying a lot of volatility. Well, this is where there wasn't much. The metals have gone quiet in here. Gold this week, net change down about 2%, and silver likewise down marginally on the week. The key has been the strength in the U.S. dollar once again, which is keeping the lid on the gold and silver markets. For all that they did have a little bit of a pop 2 weeks ago, that's petered out. And where you would tend to look for seasonal strength, the fact that the silver market hasn't been able to maintain a strong bias against gold in the last week or so, it's from my perspective getting down under 816.40 would suggest that the seasonals are going to be delayed here. Maybe they don't start until the first part of the year, and you'd want to see the miners and the silver miners outperforming silver and silver outperforming gold to get an indication that there was a reasonable low in place from which to get a decent rally.
And on the currency markets, the U.S. dollar continues to rise. Do you still see that happening into the new year?
Yes, I've been cautious on this one, been bullish but cautious. I look at a long-term cycle here, this 5 to 6 year base that we've been in the U.S. dollar, broke out in the spring. I think it's got lots of room still to go on the upside. The dollar index is trading around 89.5. The support, as we mentioned recently, is at 88. Giving up that support, I think you'd be looking at 86 and a quarter is the worst case scenario. On the upside, my target here for the dollar index is around 92 to 92 and a half, and I wouldn't be at all that we see that in the first quarter of the year. And if you couple that with the Canadian dollar, my measured target based upon the size of the consolidation that we broke down from earlier in the year still has that 84.60 as I think a reasonable number.
And I've heard the opinion as the American dollar goes up, it's helping the Canadian dollar move up, but we only compare the Canadian dollar to the U.S. dollar. If you compare the loonie to other currencies, it doesn't look that bad. Is that the case?
Canadian dollar's been holding very well relative to the euro, exceptional against the Japanese yen if you look at it over there. I'm also looking at it against the basket of commodities. Here we are, oil tending to stabilize finally. We're round numbers at $58 as of tonight. Looks as though the support is in that $53 to $54 area. Upper resistance, maybe is in that, well, for the next couple of months, I think you're still looking at a tight trading range here at a low, but over time you could probably bounce back into the $70 to $75 a year range later in the year next year. For now, though, we mentioned last week that I look at the gold to oil ratio, and the oil usually trades at the bottom end at about just under 4% value relative to the gold market, and it's getting pretty close to that. So looking at that ratio, my view is that the $50 to $52 range is probably worst case scenario for the oil market, and if it bases out in here, it then also has a relationship with the equity market. Bottom in the oil market is good for the equity market, as we said a couple of weeks ago. Weakness in oils generally brings about good strength in the U.S. equity market. However, once the oil low is set in place, you end up with an interim high in equities within the next 6 weeks. So putting all that together, if the oil wants to stabilize here, you've got the seasonal rally happening in equities. Maybe January might be a time to take a little bit of money off the table in terms of the U.S. market.
Ross, thank you very much, and best of the season.
And a Merry Christmas to you.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy. You can contact him at ross.clark@cibc.ca. Coming up, PI Financial Senior Vice President Victor Adair on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Victor Adair, Senior Vice President and Derivative Portfolio Manager at PI Financial. His website is victoradair.com. He's speaking to us from Vancouver Island. Merry Christmas, Victor, and welcome to This Week in Money.
Thank you for that. Merry Christmas to you, too, and to all your listeners.
If we could give a title to the year 2014, the year of volatility, I mean, look at what happened to oil. What's happened to a lot of different things. Look at the stock markets. Maybe start off with the markets. Where do you think they're going to go in the new year?
Well, I would imagine that if 2014 was the year of volatility, 2015 will probably be more so. It just seems like we're setting the stage for that sort of thing. Our big call this past year has been that the U.S. dollar was going higher, that it was probably in the early innings of a multi-year bull market. I've been trading currencies for 40 years. You go back to the early 1980s, first term of Ronald Reagan, we had the U.S. currency rally hugely in his first term and then fall a lot in the second term. We had another big U.S. dollar rally the second term of Bill Clinton from, let's call it 1995 to 2001. And when it ended and turned lower, interestingly enough, that was about the time that the 10-year bull market in commodities began as the U.S. dollar was going down. So you have, short-term cycles and then these much longer-term cycles. On a longer-term basis, I'd be looking for the U.S. dollar to go higher. And just like, let's say, a year ago now, okay, people, the analysts, the smart guys everybody pretty much was forecasting that interest rates would be rising as we went through 2014. Well, that sure didn't work out. Interest rates for treasuries and that sort of thing are back to lower levels than they were at the end of the year. I think actually the best trade, the best performing asset for 2014 was the U.S. long treasury bond. So what will happen next year? I don't know. I mean, markets will go up and down, move around, and there'll probably be a whole bunch of surprises and probably more volatility than we had this year.
You said there's kind of a sideways theory perhaps that you might have here, is that you believe the U.S. dollar is going to continue to go up, and there's no reason why the U.S. stock market wouldn't go up as more people buy the U.S. dollar.
Yeah, it's hard to get our mind around it, particularly, if you have an attitude, okay? You get an attitude that says that the U.S. stock market or stock markets anywhere in the world are at goofy high levels because central banks have printed so much money. Believe me, I understand that attitude, and I have embraced it from time to time. But having said that, I think if capital comes to America, like leaves the rest of the world, comes to America, where's it going to go? Is it going to go into the bond market at these levels? I think it's likely to go to stocks. And here is an example. That second term under Bill Clinton that I mentioned, 95 to 2001, the U.S. dollar rose by about 50%, while during that same period of time, the S&P 500, the benchmark of American stocks, tripled in value. And obviously tripled in value from what was then an all-time high. So could we have the stock market go a lot higher along with the U.S. dollar? Yes. And one more really big picture driver behind that is that I think all over the world you're going to have institutional money. That's pension funds, sovereign wealth funds, that kind of thing. The big money. And these guys they're trying to create a level of income to meet their future actuarial liabilities. They are not going to be able to do that in bonds. So I think we're going to see, call it pension fund money, continuing to switch out of bonds and into stocks. So here I am, a guy who has been suspicious, skeptical, whatever, about the stock market, and I've traded it generally from the short side throughout 2014. And I just kind of came around to this thinking the last few months. I thought, gee whiz, you should have just owned it. It was much easier to make money just being along the stock market.
And speaking about currencies and movement, what about the Russian ruble?
Yeah, what about that, eh? I mean, gee whiz. When something happens, we can usually, we can figure out what we would call the direct consequences of that. It didn't. I mean, you could even follow the 6 o'clock news, what I call the the nightly infotainment. The first derivative of falling crude oil prices, we can all kind of figure out, hey, gasoline's probably going to be cheaper. Duh. But here it is. Russia is hugely dependent for revenue on their oil exports. Let's call it that, natural gas as well, and the prices have collapsed. Russian companies owe hundreds of billions of U.S. dollars that they've borrowed. I have no idea how they're going to pay that back. People inside the country, obviously let's call them the oligarchs, started figuring things out here a few months ago and started moving their money out of the country. So my way of seeing this is capital flow, became a flood and became a torrent, as there was panic in the market to just, get my wealth out of this dumb currency and into anything else, Swiss franc, euro, U.S. dollars, British pounds, whatever. So, yeah, a tremendous change in the value of the Russian ruble. And I mean, by the way, the Mexican peso, the Norwegian kroner, the Canadian dollar, other oil exporting countries have seen their currencies get whacked pretty good too.
However, most other countries have economies that rely on more than just oil, and Russia's pretty well put all their eggs in one basket.
Yeah, for sure. I mean, but here's the thought. I mean, the Canadian economy, our oil exports are a big part of our total exports. It's a significant part of our overall economy, but, we are not just hewers of wood and drawers of water, but when the market is in a frame of mind where they want to shoot first and ask questions later, they see Canada as a commodity currency, so, we get whacked in this kind of an environment. But speaking of that, the spotlight has been on this big tumble in crude oil, but in behind that, natural gas is getting clobbered. Natural gas royalty revenues to the governments, particularly the provincial governments in particular, is really significant. And I think, we because of the focus on oil, we haven't seen that in behind that. Natural gas is also getting clobbered. So a real double whammy. We have had short positions in the Canadian dollar on and off here for months, and actually at these levels we're sideways on the market. We think Canada's maybe a little oversold here, very short term.
If there's going to be any other currency that picks up a lot besides the U.S. dollar, anything out there?
Yeah, it's always relative to what? The euro currency, there's a real negative attitude about the euro, and so there should be relative to, let's say, the relative entrepreneurship, the relative lack of bureaucratic things clogging up the system in the United States compared to Europe. So, and I think Canada will be seen as a place for capital to go, as well as the U.S. So Canada could do better against the euro, even though it might be weakening against the U.S. dollar. That's. I'm always looking at currencies in terms of compared to what. So Canada, I think, would do better than the euro. Canada would do better than. It's obviously done hugely better than the Russian ruble or even the Mexican peso lately.
With crude oil prices being so low as well, some people say, well, that's great for consumers. They'll have billions of dollars in their pockets now. But somebody else mentioned there's only like a $500 to $600 benefit to a family over the year. Now, if your family happens to be employed in the oil patch, well, that's not going to make up for a lost job.
Yeah. I mean, let's go to what we call high level. I mean, 3/4 roughly of the GDP in the United States is consumer spending. So, in this kind of an environment, will consumers have more money to spend? Yeah, I guess that's how it works out. Actually, speaking of oil, I mean, it's just such a battered, beaten up sector. And I'm always tempted to catch falling pianos because there's so much ego reward in being right on something like that. So I'm trying to train myself to wait for the thing to actually start to go up. But a very good friend of mine, Joseph Schachter over in the Calgary Oil Patch, who I read his stuff every month, he's actually forecasting this is a buying opportunity. And he's on a different time frame than I am, certainly, but I could be sympathetic to that. It was probably one of the reasons where we kind of just moved flat on our short Canadian dollar positions, thinking that this move is overdone here in the short term.
Is part of this dive in oil prices a direct attack on Russia, along with the sanctions that have been placed against it because of their position in Ukraine?
I've read that, and there's folks that are happiest when they're imagining conspiracies, okay? And that's not me. I think it is, I could understand why you could think that, and maybe there's something to that. I mean, that would certainly be in the realm of the things that I don't know. But I think it's just this is how markets are, whether or not there was a collusion between the CIA and the House of Saud to bring the Russians to heel, gee whiz. I mean, how would I possibly know that? What I do know is the price of oil was 107 in June as the ISIS guys were running rampant in Iraq and looked like maybe they're going to be in Baghdad next week. And now we're $60 lower than that, or $50 odd lower than that. I'm not sure why it's here. One of the reasons it's here is that we had over the last 10 years, we've had hundreds of billions of dollars come into the commodity space. I mean, it was a 10-year bull market in commodities. So this money got drawn in. Seeing commodities as a natural diversification, as a non-correlated asset to traditional stocks, bonds, real estate, what have you. And just as recently as this summer, we had an all-time record large speculator position long of crude oil. Well, in the last several months, they've had their feet held to their fire. They're bailing out of their positions, getting kicked out of their positions by margin clerks, whatever, and that selling is exacerbating the decline we have here. So that would be, to me, that's more something I can believe in than imagining that there is a collusion of political interests out there to do something, and that's what caused oil to fall down.
Are people going to be surprised about the fallout from crude and how long it's going to take to recover from it?
Or how quickly we'll recover from it. I don't know. I mean, I'm telling you, I'm looking at it right now and I'm thinking it's probably overdone, and I'm trying to train myself not to catch falling pianos. Okay, so I don't have a position in crude, but I'm sure looking at it, I'm thinking where there's been this much carnage, there's probably been a few babies thrown out with the bathwater. There's probably some companies out there that are really worth buying at this level, or just crude itself.
Well, what about Europe?
I don't know.
You're also saying in Europe they have shut down perfectly efficient power plants that are using fossil fuels, I guess, or some other kind of fuel in that manner, but they've switched to wind and solar farms. How's that worked out for them?
I really wouldn't know, but I would say that this tremendous break we've had in crude oil prices, in coal prices too, by the way, that's off the radar screen. Coal prices are at multi-year lows. Natural gas, with these, let's call them generally fossil fuel prices coming way down like this, is probably just about the worst thing that could have happened to the alternative energy space, because now, fossil fuels are so cheap, so, why bother chasing that other stuff? So that would be my cynical trader's way of looking at that. We've had tremendous volatility in the stock market just this week. I mean, let's go, where are we at here? I mean, this was on December the 5th, which is the first Friday in the month. We had the Dow Jones close at an all-time record high. A week later, the 12th, the market had taken a tremendous fall and had closed below the lows of any of the previous 5 weeks. We had this dramatic breakdown, and now we're right back to where we were last week after a real huge round trip this week. And this market psychology, this sort of swinging from pillar to post, is pretty dramatic. I think the way I'm participating in this market is I'm participating with very cautious size. I'm certainly not taking any big positions. It looks to me as though the bull market in stocks wants to continue.
Are we going to see again another round of these quantitative easings from various bodies around the planet?
Well, let's ask ourselves, why are they doing it? And then we might have a better answer as to whether or not they'll continue. And from my perspective, we are in a deflationary world. We've had a huge expansion in the economy that was fueled by credit. We had a major credit blowout in 2008 and into 2009. The central banks are trying to push money out into the economy to get it going again, and it seems to me they're fighting a rear guard action that, if anything, for all the trillions of dollars that have been printed and put out there with interest rates down, at ankle high levels for the past 5 years, what do we got? So then if you have that perspective, then I think the answer is obvious. Yes, there will be more quantitative easing ahead. Why would it not? I mean, we just had the Federal Reserve this week, and they were in a position where the market was expecting that maybe they would be a little gentle about saying we're going to put up interest rates because of the collapse in oil prices, because of the turmoil in currency markets and so on. And maybe they were. They seem like they're not going to be in any hurry to push up interest rates. The CPI data we had this morning in Canada probably plays into the view that the Bank of Canada is not going to be in any hurry to try to push up interest rates. What's going on in Europe makes it look as though they're going to have to finally do something over there to try to stimulate the economy. It would seem at some point that all of this doesn't work, and maybe, the taxpayer says, okay, I've had enough, but I don't think that the taxpayer is out of Sleepy Hollow yet on that score.
Victor, thank you very much for talking to This Week in Money.
It's been a pleasure to talk with you, Jim. Thanks.
My guest has been Victor Adair, Senior Vice President and Derivative Portfolio Manager at PI Financial. Check out his website, victoradair.com. After the break, John Mauldin on This Week in Money.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is John Mauldin, founder of MauldinEconomics.com. He's on the line with us from Dallas, Texas. John, welcome to This Week in Money.
It's always good to be with you guys. I hope your weather's a little bit better up in Vancouver than it is right here.
Well, with us, there's always a rain shower around the corner. It doesn't matter if it's sunny. But that's what we get for living in a very nice part of the world that gets a lot of rain. I'd hate to
Vancouver's one of my favorite cities in all the world that I've traveled to.
John, maybe you could first start us off with telling us about your newsletter.
Well, I started writing it about 15 years ago to a few thousand people, and now it's grown up to, that we push out to close to 1 million people. It's still a free letter. I write it every Friday. I'm in the middle of writing it again. Sometimes it slips over to writing Saturday and Sunday, but I'm middle of writing it again right now.
And where can people get more information about it?
Just Google John Mauldin is the easiest way. We're at Mauldin Economics. You can give us your emails that you can subscribe to it and be one of my 1 million closest friends.
Well, Dallas is right in the middle of the oil patch in the U.S. I grew up in Alberta, which is just Texas north, I would think.
It's part of the panhandle, I think.
Absolutely. The drop in crude oil prices, that has got to be one of the biggest shockers of the year.
You could see an oil price softening coming, just because you could look at the demand was beginning to soften around the world, and between Canada and the United States, we're introducing, an enormous amount of new production into the system. There's a lot of other slack in the world, and production overtook demand, and we know what happens when that happens. Prices go down, and for those of our listeners today that are familiar with the ups and downs of the oil market, I've seen single-digit oil prices 2 or 3 times in my life. I mean, we go from boom to bust to boom to bust. Oil will go back up, at some point, a few years, and we'll look back and go, wow, that was hard. Especially if you're in Alberta or Texas, North Dakota, it's going to have an impact on the local economies, no question about it.
People have told me without the oil industry, we would have been in a big recession already.
I don't know that we would have been in a recession, but the United States would have looked more like Europe. There's no question that depending on, and it's really depends on how you want to look at the data. You could easily say 50 or 60% of the job growth, which is 30 or 40% of GDP. You can argue that it was even more important in the U.S. Was from energy production and the related items that go along with it. So our growth would have been, instead of being in the 2.5 range over the last 3 or 4 years, it would have been in the 1% range. And that's a pretty different looking recovery. It looks like Europe. It doesn't look like, the United States.
What positives and negatives do you see from this big drop in oil?
Well, I mean, the positives are the one that we all talk about. And so you have so many economists talking about. A drop in oil looks just like a big tax cut to the middle class and people who are spending a higher portion of their wages on gasoline and energy-related products. And that's no doubt going to allow people, rather than spending money at the gas pump, they can spend it on something else. So it's going to spur consumption. Now, it just changes the consumption patterns It's not going to increase consumption. It's just going to move it to other businesses. That's all the positive. The negative is that, it is definitely going to impact jobs. Right now, in my letter a week ago, I talked about a report from the Manhattan Institute, which showed that there's 20 states in the United States that have had over 150,000 jobs created in this process that are directly related to the oil patch. And so it's not just a Texas, North Dakota play. It's going to affect all of the United States. And the job growth we've been seeing is probably likely to weaken, and we could actually even see later this year unemployment beginning to rise. Now, understand, oil production isn't just going to drop off first quarter of next year. There's a lot of things that are, to pardon the pun, already in the pipeline. People have contracted for drilling rigs. They've bought the pipe. They've made commitments. They've got the money. They've got to do something with it. And so they've got sunk costs. So they're going to go ahead and continue to produce. And, so we could see production actually going up in 2015 from 2014. But towards the end of the year, more and more projects are going to get canceled. But they're projects that would have started in June, July, and in April, May. So those projects aren't going to happen, and that's when you begin to see losses in jobs and economic activity. Now, what that means is eventually the price for drilling rigs, the price for everything is going, in terms of energy production, is going to go down. And my guess is with the increase in technology in oil production, things that are happening, $60 or $70 oil, which is my guess is the where we get back to, and that $50 to $70, we trade in that range. We'll be able to drill a lot of oil in that range, and get kind of the production schedule going back, because we're going to be able to pull more oil out of the ground, with far less dollars.
I know so often when the price of oil starts to go down like this, OPEC will turn off the taps or at least tighten them up a bit. But this time they said, we're not going to do it. Any chance that North American oil producers would say, well, hey, we want higher prices. Why don't we cut back? Would that work? No, because what you've got is 10,000 American oil producers, and you're just not going to get them to cooperate. That takes a, kind of a single government control like you have in Saudi or Iran or other countries where a group of guys sitting around the table can go, this is what we're going to do. You can't get 20,000 oil well producers to come together. Even if you had the 10 majors, they say, okay, we're all going to cut our oil production. You've got every little, driller in the country that would go, well, that's great. We'll sell into that. So I was going to say 20,000 oilmen, they can't even agree on the color of the carpet in the oil producers club.
I'm throwing that number out. I don't know if it's 50,000 or, there's a lot of small, but there's something like, I think it was 20 or 30,000 small businesses with 15 people or less in the oil patch. You'd be surprised how many, small wildcatters and people there are that, they're small firms, and they've got 5 or 10 wells or 50 wells, so they're not big players at all, but it's their little family business, and it's producing well, and they're happy with it.
Was shale oil in a bubble?
It was probably in a debt bubble. Cheap money given, by the central bank, and a reach for yield. There were so many covenant light loans given to, I don't want to call them subprime oil companies, but companies that, the economics were iffy, if there was a drop in price of oil, allowed the shale oil, boom to occur. It was helped along by amazing new technology. The amount of oil we're pulling out per well and the cost per well is going down, and we're pulling out more oil per well. with the new fracking techniques and technology that we're using, it's really what people don't realize is that oil and shale is a technology play as much as it is anything else.
Is Russia strengthened or weakened by the price of gasoline and oil? Or is this a real major blow to them, and can they come back from it, and how might Putin react to it?
Well, I mean, it's certainly going to weaken them, no question. Will they come back? Sure, I don't know in what form. They don't want to give up, meddling around in the eastern part of Ukraine, so I don't see sanctions going off. They seem to be willing to endure the pain. Okay. Putin's certainly going to have less money to spend messing around with the rest of the world. So, I mean, the Russian ruble has, dropped by 50%. Inflation is going to be double digits, mid-double, could be, in the mid-teens in Russia next year. Food is more scarce and less variety. So it's not without pain there.
Could that provoke him to, say, invade some of the southern nations that used to be part of the Soviet Union, where the production of oil there is very cheap, it's shallow, whereas most Russian oil is up north and pretty expensive to bring out?
Putin's a wild card, but he's got a country that's in stress. They're having to deal with their dollars. They don't want to have to deal with even more sanctions. And the military's under stress. They've only got X amount of equipment. And remember, this is a country that is demographically imploding. They have fewer young people. The men die earlier. It's not an easy situation if you are a president of a country to try to figure out how you lead people in what is, a slow-moving train wreck.
What do you believe is the reason behind the U.S. normalizing relations with Cuba after 50 years of blockade?
That was kind of a strange one. It came out of left field to me. There's been calls for a long time to normalize relations. Part of the reason it hasn't is that Florida, quite frankly, is very important in presidential elections. And, nobody wants to go into Florida with its huge Cuban population and say, let's normalize relations. The Cuban population in Florida does not want to normalize relations. So you have a president in the United States now who's not running again and just says, this is what I'm going to do. Now, understand, this is just a first move. This doesn't remove sanctions. Those are congressional mandates. What Obama did was set more of an opening for discussions about what would open up and how you might get congressional approval. But this Congress is not going to be in a mood to approve something without getting more than a few prisoners from the Castro brothers.
The business opportunities, I've been told, in Cuba are terrific, especially if you're looking at, say, charcoal or sugarcane, things like that, or tourism. How about that? Canadians have been going to Cuba for cheap holidays forever, and they said with a bunch of Americans now able to do that, if this all works out, that's going to make that vacation more expensive just because of demand.
I don't see a horde of Americans coming down there yet, but it will help their local economy if they start building hotels and creating more of a tourism market. I'm going down to Caymans here in a few weeks. I've been to Jamaica, Bahamas, Bermuda, some of the other islands. There's a lot of islands down there that they have to compete with.
Well, moving on from Cuba, the rum there is terrific. That's what my friends tell me. Is the strength of the U.S. dollar going to continue?
Yes. I mean, I think I've said that on this show 3 or 4 years ago. And one of my recurring themes in my speeches for a long time has been the dollar is going to end up becoming stronger than anyone can possibly imagine. I remember 7, 8, 9 years ago being in Canada, speaking at a bond conference and saying This was when the loonie was at like 67 or 70 cents to the dollar, and saying that Canadian dollar is going to go to parity with U.S. dollar. And literally people in the room laughed. And they just don't, it's so hard for people to see past the next 3 months or 6 months when they think of currency moves and what can, but these are big capital flow, movements. And the way the world is situated now, the rise in the dollar has a real, very real chance to create an emerging markets crisis. China is exacerbating the problem because of their own financial and economic concerns. I mean, they're going to slow down. That means they're going to buy less commodities. China's slowdown is, I mean, forget whether they have a hard landing. A slowdown is a big shock to the world. And if they have a hard landing, it'll be like anybody else's recession. You deal with it, you cut it, and then you start growing again. But the euro is going to parity against the dollar. The yen is going to 200. Japan's launched a major world currency war. It's what I'm writing about right now. And the beneficiary of that is the cleanest shirt in your closet, is the dollar. I mean, we will become, and to some degree, it's going to help the Canadian currency, as well. The reason Canadian currency is not seen as a safe haven as much around the world is it's just not big enough. If Canada was the same size as the United States, my opinion would then say the Canadian dollar was going to be stronger than the U.S. dollar, and that's where everybody would go. Same thing with Norway. I mean, if Norway or the Swiss were bigger and could absorb the dollars, then they would become the safe haven currency, because I think those countries are better managed. I think your country is, I've got some things I'd quibble with, like any, I quibble a lot with mine, but I think your country is pretty well managed vis-a-vis the United States, and more acceptable in the world. That being said, you couldn't absorb all the global currencies. The United States is big enough to be able to do that. Switzerland's, in January 22nd, they're going to have negative interest rates. If you want to put money in their banks at their currencies, you're going to actually pay money to be in the banks. Because take your currency and go home. They want you to buy their Toblerones and their machine tools and all that stuff, but they don't want you to take the Swiss, because the Swiss franc is incredibly overvalued. I go to Switzerland once or twice a year, and it is the most irrationally expensive place in the world. When you're paying $9, $10, $11, $12 for a Diet Coke in Geneva, that's just crazy.
Any chance that China's currency could replace the U.S. currency as the world reserve?
No. I mean, to be a reserve currency, there's lots of requirements. And now, could the renminbi over time become a reserve currency that's seen as something that you want to sit and hold? Yes. But then they've got to prove their stability against the dollar. They're going to have to open their currency account up. They're going to have to assure no capital controls. They're going to have to be a country that you can trust their management. I mean, you don't want to put your money in a reserve currency when you don't, it's 7 guys sitting around the table with a couple strong guys at the top. This is not exactly a, freewheeling democratic country. It takes time to be accepted. Now, if you're Indonesia and 15% of your trade is with China, and then, you've got your businesses that need, something to buy Chinese materials in, and vice versa. Well, yeah, you might want to hold a part of your reserves in renminbi and do your own dealing, and then completely avoid the dollar. And so you just avoid the friction of going from, the rupiah in Indonesia to the dollar, then to renminbi and back, and you just deal straight. So that's a rational choice, but that's a far cry from the banks in Europe or Asia or Africa saying, I want to hold apart from my trade, this is what my reserve currency is. That is a far different story. I can walk in dang near any place in the world and I can put my dollars down and figure out something to do with it. You can't do that with renminbi.
Precious metals. What do you think is going to happen with gold and silver in the new year? And is there any preference one over the other?
Well, I would prefer gold. I mean, to me, silver is becoming more and more of an industrial metal as opposed to a precious metal. And to some degree, gold's going to have pressure on it because of the rise in the dollar. If I wanted to own gold and I buy gold as insurance. So its true value is going to be when we see gold as that we need it as insurance. When the world needs gold as insurance, then we're going to find out what gold's worth. But until then, it's just another fluctuating currency, and I don't really see it as an investment. It was clearly undervalued in the late 90s and early 2000s. I mean, I think it was early 2000, January of 2002, and I was making my forecast. I say we're in the start of a gold bull market. Gold's probably a lot closer to whatever fair value is. It wasn't so distorted. It's not as distorted as it was. I think it makes sense for most people just to accumulate a little gold over time and, stick it back in a vault and, hope that you give it to your great-grandchildren, because that means you never had to use it.
Do you see the American economy and employment growing in the new year?
I think the American economy grows more slowly in the last half of the year. We're going to have to figure out and understand what the impact of oil was. The impact may be a lot more significant than we thought. Job growth is going to be far more muted in the out months as we don't see job growth from the oil patch. And so now,
taking a look at Asia again and BRIC, what effect would the BRIC companies' development bank have on geopolitics? They don't want to use the World Bank.
Let's see them do it. Really? I mean, okay, you have 4 or 5 players who have completely divergent views from each other and want to do different things, they're all in financial stress in one form or another. So they're going to come together and find money to give to common cause to countries that, India and Russia might not have the same interest as giving money as China or Brazil. Let's see how that works. Remember, the IMF was started and funded because the United States was basically the big guy on the block, and we funded it. Now Europe and other countries fund it. I completely understand the motives of the BRIC companies wanting to fund their own development bank, and I applaud them, and I hope they do it. I think that would be a great thing for the world. I would love other people to step up to the plate, but come back and ask me in 2020 how it worked.
Why was the CIA torture report released, and will there be consequences from it economically?
There will likely be no economic consequences, and the torture report was a total political statement by the Democratic Party. You have to remember, this was put out by Senate staffers, Democrat Senate staffers. No Republicans were allowed to be involved in the process. The Senate staffers interviewed no CIA people at all. This was all from documents. This was all from third parties that had access to ground. They wanted to embarrass the previous administration and call attention to something else besides their own problems. Now, that doesn't mean that there wasn't with all that smoke, that there wasn't some fire and there weren't some problems. I'm not excusing that. But what did that report tell us? We already knew everything that was in it. We already knew they were waterboarding. Okay. I don't think governments around the world learned anything they didn't know before. And so it's very unlikely they're going to retaliate. This was all political machinations, and both parties do it. It's not pretty, but it's American politics.
The hacking at Sony, and we know North Korea is behind it now. Is this an excuse to rein in internet freedoms?
I certainly hope not. I think, quite frankly, of all the problems and dumb ideas that the Obama administration has done, nearly everything else can be fixed if we just go through another election and we fix it. I mean, maybe it's just that I'm 65 years old and I've seen, all of this. It's, one of my laugh lines is, the country is going to be just fine. We lived through Jimmy Carter. We made it. Well, we could make it through Obama. The one dumb thing that's really could be disastrous, and I hope somehow or another it gets fixed this next year, is Obama is wanting to give up U.S. control of the internet and internet freedoms and put it to some governing council where the dictators of the world are going to have input on policy of who gets access to what. And right now, good, bad, or indifferent, the United States says everybody gets it. No, it's the internet as we all know and love it. And it creates problems for the dictators, and they're all wanting to change that. And Obama, trying to look good in the world, says, well, let's talk about it, and we're going to change I forget the name of the group, ISD, something like that. That could be a disaster, because once you let that cat out of the bag, you're not going to be able to get it back in. That's probably something that would do more to damage the future freedom and information of the world than anything else that's been done in the last 7 years.
The internet continues to dismantle the traditional ways we do business. Are there sectors that look like they're about to go through any kind of transformation because of that?
Because of the internet?
Yeah.
Well, I mean, a lot of sectors are continually seeing new innovations, new communications. Everybody uses it. The financial world, the information world that you're in. I mean, you're now, you've got a website, you're communicating to people. I mean, we've all changed the way we do business. I think the whole way we communicate communications is a central part of the human experiment and how we deal with each other. I mean, there's other industries that are going to go through massive changes over the next 10 years. The world is just getting ready to explode with new things where we're already seeing there's a bubble sold 100 cars in Sweden earlier this year that are automated driving cars. They're on the road today driving around in Sweden. This is their beta test. This is not Google cars sitting over there still trying to figure out how to do this. This is a Tesla having a car that will, keep you in lanes. This is Volvo's there. And we're going to see in 5 years, maybe we'll start seeing the first few cars in some countries that are forward thinking. In 10 years, we'll have automatic driving cars, in the U.S. And my guess is the first real adoption of it's going to be is in the trucking industry. Because there you're taking something from point A to point B. You're using interstate highways. And that type of, it's hard to get drivers and it's not a very fun job. Well, now you can put a truck on the road, 22 hours a day without having to have a driver in there. And they can drive, all day, just pull in, get gas, have your team, to pump it, and, then it heads back out, on the freeway and takes off. I think that's going to be a revolution. It's going to reduce costs. I quite frankly am looking forward to having my first automatic driving car. I'm one of those people that when they ask me, are you a better than average driver? I have to say no. Somehow or another, 80% of America thinks they're better than average drivers. But I recognize that I'd be safer and better off in the world with me if I wasn't driving because I get distracted. So I'd rather sit and read or do something else and have my car take me from point A to point B. And by the way, a lot of the upcoming generations will too. I mean, there's still people who are going to want muscle cars and they want the experience of driving, the freedom of the road, but that's going to be a huge change. Robotics is going to be massive. 3D printers will show up in the next decade. Technology is bubbling along. Google and Facebook are trying to figure out how to put balloons and or drones at 65,000 feet. You can put, 40,000 of them around the world, and you can blank the world with the internet. And it's not very expensive. High balloons would be, able to blanket the world with the internet for $1 billion a year. By the way, but this high balloon thing, it's being done right now. They're running it through India and Australia, in their tests. They're going to circle the globe this next year along some parallel that covers India, Africa. This technological information world we're going to, it's really changing.
Thanks for being on This Week in Money, John.
It's good to be with you guys. Thank you so much.
And best of the season.
Yes. Holiday wishes for everybody and all the listeners.
Well, that wraps up our show for this week. Thanks to our guests, Ross Clark, Victor Adair, and John Mauldin. And thank you for listening. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.